Imagine you are about to buy your dream home. You have saved up for years and the house is perfect, but then your loan application gets denied because of a low credit score. This highlights the importance of a good credit score. It opens doors to financial opportunities and secures loans at favorable rates. Maintain a good credit score for financial health. A credit score is a numerical representation of your creditworthiness. It ranges from 300 to 850, with higher scores indicating better creditworthiness. Lenders use credit scores to assess the risk of lending to you. The score is based on your credit history, which is a record of your borrowing and repayment activities. Credit scores are generated using algorithms. These algorithms analyze various factors from your credit report. The most commonly used credit scoring models are FICO and VantageScore. Each model has its own method of calculating the score, but the key factors remain consistent. Your credit score influences the terms of loans and credit cards you can access. A higher score means you are more likely to get approved for credit. Additionally, it can result in lower interest rates and better terms. Conversely, a lower score can limit your borrowing options and lead to higher costs. Understanding what a credit score is and why it matters is the first step. Next, we will break down the factors that contribute to your credit score. Knowing these factors will help you take control of your financial health. Credit scores fall into different ranges, each representing a level of creditworthiness. The ranges are generally categorized as follows: 300 to 579, poor; 580 to 669, fair; 670 to 739, good; 740 to 799, very good; and 800 to 850, excellent. These ranges help lenders decide whether to approve your credit application and on what terms. A score in the poor range may indicate a high risk, leading to denial of credit or loans. If approved, it often comes with high interest rates. Scores in the fair range show some risk, but may still qualify for loans with less favorable terms. Good scores indicate responsible credit behavior, leading to better loan conditions. Very good and excellent scores represent low risk. Borrowers with these scores are often offered the best interest rates and loan terms. Keeping track of where your score falls can help you understand your credit status. It also provides insight into what you need to improve. Each credit range comes with its own implications. Knowing your score range can help you make informed financial decisions. In the next sections, we will explore the factors that influence these scores in more detail. One of the most significant factors in your credit score is your payment history. This accounts for about 35% of your overall score. Payment history reflects how consistently you pay your bills on time. Late payments, missed payments, and defaults can severely impact your score. Lenders view payment history as an indicator of future behavior. A strong record of on-time payments suggests reliability. Conversely, a history of late payments can signal financial instability. This makes lenders wary of extending credit to you. To maintain a good payment history, always pay your bills on time. Set up reminders or automatic payments to avoid missing due dates. Even one late payment can affect your score, so consistency is key. Regularly checking your credit report can help you spot any discrepancies. If you find errors, dispute them immediately. Ensuring that your payment history is accurate can significantly boost your credit score. Section 5. The role of credit utilization. Credit utilization is another crucial factor that influences your credit score. Credit utilization accounts for about 30% of your score. Credit utilization refers to the amount of available credit you are using. It is calculated by dividing your total credit card balances by your total credit limits. A lower credit utilization rate indicates responsible credit management. Lenders prefer borrowers who use a small portion of their available credit. Ideally, you should aim to keep your credit utilization below 30%. High credit utilization can signal to lenders that you are over-reliant on credit. This can lower your score and make it harder to get new credit. Paying down balances and keeping low credit card debt can improve your utilization rate. Monitoring your credit utilization regularly is essential. You can do this by checking your credit card statements and staying within your credit limits. Managing your credit utilization effectively can lead to a higher credit score. Section 6. Length of credit history. The length of your credit history contributes about 15% to your credit score. It includes the age of your oldest account, the age of your newest account, and the average age of all your accounts. Generally, a longer credit history is seen as more favorable. A longer credit history provides more data for lenders to assess your creditworthiness. It shows how you have managed credit over time. Closing old accounts can shorten your credit history and negatively impact your score. Maintaining older accounts can help improve this aspect of your credit score. Even if you are not using an old account, keeping it open can be beneficial. However, ensure that there are no annual fees associated with unused accounts. It is also important to regularly review your credit report. Make sure that the length of your credit history is being reported accurately. An accurate and lengthy credit history can positively impact your overall credit score. Section 7. New credit and credit inquiries. Applying for new credit can affect your credit score. This factor makes up about 10% of your score. When you apply for a new credit card or loan, the lender will perform a hard inquiry on your credit report. Too many hard inquiries in a short period can lower your score. Each hard inquiry can reduce your score by a few points. However, the impact is typically temporary. It is important to note that checking your own credit report results in a soft inquiry, which does not affect your score. Limiting the number of new credit applications can help maintain your score. If you need to apply for new credit, do so sparingly. Grouping similar credit inquiries, such as for a mortgage or auto loan, within a short period can minimize the impact. It is beneficial to understand how credit inquiries work. Being cautious with new credit applications can help you avoid unnecessary dips in your score. Properly managing credit inquiries is a small yet significant part of maintaining a healthy credit score. Section 8. Types of credit in use. Having a mix of different types of credit can positively affect your credit score. This accounts for about 10% of your score. Types of credit include credit cards, retail accounts, installment loans, and mortgage loans. A diverse credit portfolio shows lenders that you can manage various types of credit responsibly. It indicates that you can handle both revolving credit, like credit cards, and installment credit, like loans. However, it is not necessary to have every type of credit. Opening new types of credit solely to improve your score is not advisable. Instead, focus on responsibly managing the credit accounts you already have. Only take on new types of credit if you truly need them. Balancing your credit types can contribute to a higher score. Ensure that you are making timely payments on all your accounts. A well-rounded credit profile demonstrates good credit management to lenders. Section 9. Tips for improving your credit score. Improving your credit score may seem challenging, but it is achievable with discipline and consistency. Here are some practical tips to help you boost your score. First, always pay your bills on time. Late payments can significantly lower your score. Set up automatic payments or reminders to avoid missing due dates. Consistent, on-time payments build a positive payment history. Second, keep your credit utilization low. Aim to use less than 30% of your available credit. Pay off your credit card balances in full each month if possible. Reducing high balances can quickly improve your score. Third, avoid opening too many new credit accounts at once. Each new application results in a hard inquiry, which can lower your score. Be selective about the credit you apply for and space out your applications. Lastly, regularly review your credit report. Check for errors and dispute any inaccuracies. Keeping an eye on your credit report ensures that it accurately reflects your financial behavior. Section 10. Conclusion: managing your credit wisely. In conclusion, understanding how your credit score is calculated is crucial for managing your financial health. A good credit score opens up many financial opportunities and can save you money in the long run. It affects your ability to secure loans, rent an apartment, and even get a job. Key factors influencing your credit score include payment history, credit utilization, length of credit history, new credit, and types of credit used. Each factor plays a significant role in determining your overall score. Managing these aspects wisely can lead to a higher credit score. Improving your credit score requires consistent effort and responsible financial habits. Pay your bills on time, keep your credit utilization low, and avoid unnecessary credit inquiries. Regularly reviewing your credit report can also help you stay on top of your credit health. By following these tips and understanding the factors that affect your credit score, you can take control of your financial future. Remember, a good credit score is not just a number. It is a key to unlocking better financial opportunities. Manage your credit wisely and enjoy the benefits of a strong credit score.